Want to know the secret strategy that can help you invest smarter, reduce risk, and potentially grow your wealth over time? Let's dive into the world of dollar cost averaging. Imagine you're on a roller coaster. Sometimes it's thrilling, and sometimes it's a bit scary. That's what investing can feel like, right? But what if I told you there's a way to make that ride a little smoother? So, what is dollar cost averaging? Simply put, it's an investment strategy where you consistently invest a fixed amount of money at regular intervals, regardless of the asset's price. Think of it like filling up your gas tank. You don't wait for gas to be super cheap. You fill up regularly, so you avoid that dreaded, "I should have bought more at $2.50 regret. Now, why should you consider dollar cost averaging? First, it helps mitigate the impact of market volatility. Let's say you're investing in stocks. Some days they soar, and other days they plunge. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. It's like buying bananas when they're on sale and less when they're not. Over time, your average cost per share goes down. Let's put this into perspective. Imagine you decide to invest $100 every month in a particular stock. In January, the stock is $10, so you buy 10 shares. In February, it jumps to $15, and you buy just over 6 shares. Then, in March, it drops back to $8, and you grab 12. Over 3 months, you invested $300, but you have 28 shares in total. Your average cost per share? Just over $10. That's the magic of dollar cost averaging. Now, you might be thinking, this sounds great, but what if the market is constantly going up? Well, even in a rising market, dollar cost averaging works in your favor. It encourages you to stay disciplined and invested rather than trying to time the market, which is notoriously tricky. Most investors find it hard to buy when prices are high, but dollar cost averaging keeps you in the game. Let's talk about risk tolerance. If you're someone who gets anxious watching the market's ups and downs, dollar cost averaging can give you peace of mind. It's a way to invest without stressing over daily price changes. Just set your schedule, maybe the first of each month, and stick to it. This approach not only smooths out your investment journey, but also helps you build a habit of saving and investing. So, what's your time horizon? Dollar cost averaging works best for long-term investors. If you're planning for retirement or saving for a major life event down the line, committing to a consistent investment plan can help you weather market storms and stay focused on your goals. Now, let's address a common question. Is dollar cost averaging always the best strategy? While it's a fantastic tool, it's not a one-size-fits-all solution. If you have a lump sum to invest and the market is favorable, you might want to consider investing it all at once. Just weigh the pros and cons based on your personal situation and comfort level. Before we wrap up, here are a few key takeaways. Dollar cost averaging reduces the impact of volatility. It promotes disciplined investing, helping you stick to your plan. It's particularly effective for long-term goals. So, are you ready to give dollar cost averaging a shot? Maybe you're already using it without realizing it. Let us know in the comments if you've tried this strategy and how it's worked for you. And if you're curious about other investing strategies that could boost your financial journey, don't miss our next video where we'll uncover the benefits of index funds, an asset class you might be overlooking. Until then, happy investing